Hello, everyone. My name is Chris Powers, and I want to thank you so much for joining me today on the Fort Podcast. This show is an open-ended discussion and journey covering real estate, business, entrepreneurship, and investing. I would love to hear from you by tweeting me at Fort Worth Chris on Twitter. And if you've enjoyed this show, I would be super grateful if you would follow it on Apple, Spotify, or whatever platform you're listening on. And if on Apple, it would mean a lot if you'd leave a rating or review. And last but not least, you can check all these episodes out on YouTube. So thank you again for joining me and enjoy the show. Today's episode of The Fort is brought to you by none other than Fort Capital. Fort Capital is a real estate investment firm based in Fort Worth, Texas, with a track record of acquiring more than $587 million in assets throughout the great state of Texas. The team over at Fort is currently looking to acquire Class B industrial properties between $10 and $75 million throughout the major metro cities in Texas. In fact, Fort Capital was named the fastest growing real estate company in Texas by Inc. magazine last year. To learn more about Fort Capital, visit fortcapitallp.com. Hey guys, it's Chris. Today we are going to be talking about why real estate investment companies ultimately make a decision to sell real estate. There's actually a lot of reasons. There's not just one, and there's a lot of nuance, and we're going to try and cover that today. It's been a big topic. I've talked a lot about it, especially on Twitter. There's multiple viewpoints. There's no right answer here, but this episode is supposed to give a little more clarity on why you would see somebody sell as companies grow, as incentives change, as markets change. There are reasons to hold forever. There are reasons to sell, and we're going to dive into that today. So for clarification, we're talking today about investment properties or cash flowing assets. We're not talking about residential homes used as a primary residence. And I'm also focusing the majority of the episode on real estate investment companies whose full-time job is real estate investing. I'm not as much talking about single individuals who own a few investment properties and aren't full-time real estate investors. With that said, a lot of these points are attributable to the single individual. So let's get into it. What are some reasons to sell? Assets are no longer part of the company's core strategy. Selling allows them more time to focus on priorities. You see this all the time. You'll see companies that own lots of different types of assets. They might own some multifamily, they might own some office, they might own some industrial, they might own some retail. And oftentimes, some of those assets are such a small part of their portfolio and end up being more of a distraction than an accretive value to the company. They might have 80% of their assets in multifamily and have, one random office building or one random industrial building. And so they'll sell because it's just not their core focus. Business plans change. If you had looked at Fort Capital's portfolio back in, 2016, 2017, we were all over the board. We had multifamily, we had office, we had land, we owned some student housing, we owned newly built apartments. We also owned Class B apartments. So we were all over the board, and we made a business plan decision in 2016 to focus all of our energy and time on industrial. Part of that meant, in order to do that, not only would our focus be on it buying industrial going forward, but we really wanted to sell off our non-core assets that were going to be things that we weren't putting all of our attention on going forward. And so over the next 4 years, we sold a lot of what we would have called our non-core assets, or those that basically weren't industrial. As business plans change, there can also be misalignment. You have legacy assets in a portfolio that, the team is not in the promote on because maybe they joined the company after, or the structures of the company changed. And so sometimes it's easier to sell off the assets so that you create full alignment, and the assets that the team are working on, they're invested in as well. This can also happen within partnerships. You might have a partnership that's not going well, or a partnership that needs restructuring, and it's easier to just sell and get out of the asset than to keep the asset and try and work things out. Another reason that people sell again, as not part of the company's core strategy, are a lot of companies start doing larger deals. And so they might have legacy assets that are really small. I mean, at one point, 5, 6 years ago, we still owned a couple of single family rental homes from 10 years prior near TCU. When you have a full staff and full overhead, the time required to manage that one single unit can sometimes be too much. The juice in that case isn't worth the squeeze. So you'll see people sell assets that might be too small and too time consuming when there's bigger fish to fry. Families will often sell assets to satisfy estate issues. So you'll see very often that folks are selling because even though they might own a professional real estate company, somebody in the family might have passed away or they're doing some estate issues. And in order to clean up or possibly pay taxes or something of that nature, you'll see properties get sold. Another reason people will sell is an obvious. The market's really high and an offer comes in that's too good to pass up. Maybe the company had projected on a 5-year plan that they would return X to their investors. And either they beat that plan very quickly, or by year 5, they have absolutely blown the cover off the ball, and it just makes sense to sell. Another reason why people will sell there are better opportunities to redeploy the capital. So if you have an asset that's returning X and you see another asset that is going to do a lot better, or you perceive is going to do a lot better, you'll see people sell one asset and redeploy the capital into the next. This can also be done through a 1031 exchange, which most people know about. That's a tax-deferred exchange. But again, if you have a better place to put your capital that can return more, you'll often see people sell and redeploy the capital. And one that's not a no-brainer, it is a fact of life. Some people just sell to take profits. Especially early in your career, profits can be life-changing for GPs and LPs, and it's an opportunity to take some chips off the table. As you get later in life and the real estate firm matures and you have lots of deals, it's easier to hold on, especially if you've had some liquidity events. But for people younger in their career, selling an asset or 2 or 3 could be a life-changing amount of money, and that shouldn't be taken lightly. Again, it's situation dependent, and we're not going to harp on just the 08, 09 era. But I've talked to a lot of people over the years that said, they were thinking about selling in 05, 06, 07, but things were so good, they just thought it would go on forever. And they didn't sell. And it took sometimes 5, almost 10 years to get back to the values at which they could have sold at in 07. Nobody can time the market, and that's not a statement on timing the market, but it is a statement on, when things are good and there's an ability to take the chips off the table. And as a company and for LPs, there could be life-changing dollars. It's something to seriously consider. I always say taking profits and paying a little tax is not the worst thing that can happen to you. And a friend of mine once told me a quote that I always think about is, you can't go broke taking a profit. So people sell to take profits. People sell because market conditions are changing. In a downturn like the Great Financial Crisis, companies sold because the incentives for the GP to continue operating weren't there anymore. They were essentially out of the money. So in these deals, GPs will structure investments where there's usually a preferred return with a carried interest or promote at the end. And when assets have depreciated in value by a lot and a GP sees no pathway to recouping the promote, you'll often see in downturns folks selling, not because it's necessarily the asset's going to go bankrupt, but because the GP's time is not going to add up to future outcome. And so they will go ahead and let assets go so that they can redeploy capital and spend time on assets where they could make money. You see this across the board. So when GPs get placed out of the money, there is a decision to either sell or at the very least, you often see them try and renegotiate something with LPs to keep incentives intact. A good GP will work with their LPs first before making a decision to sell, especially in a downturn. If LPs are not willing to continue on, you'll often see a forced sale that is imminent. So again, especially within funds and true real estate private equity, if incentives aren't there for the GP to continue on, it's often a time that you'll see assets get sold. Another reason why people sell, they cross-collateralized deals. So you'll see sales happen on a performing property because maybe another investment is struggling and cash is needed, or banks are calling for a pay down of a loan. And so, especially in a lot of funds, you'll see cross-collateralized assets, but you'll see them even with folks that do deals on a deal-by-deal basis. They'll sometimes cross-collateralize, and while one asset might be going great, if another asset's not, and there's a call from the bank, you might see an asset get sold to satisfy issues happening in another property. People sell just to take risk off the table. I don't have to go too much into that, but people might feel like there's risk in the market or risk within their portfolio, and it's a good time to sell and take some risk and some chips off the table. Another reason why people sell is real estate actually depreciates and requires CapEx. I know we've been living in a bull market where prices continue to go up, but the physical deterioration of the actual building is real. It rains, it snows, it hails, time goes on, and buildings start to fall apart. And investors might see that they're pouring way too much capital expenditures into the building to keep it up to par. So you might see them sell. Some groups would rather sell than constantly maintain a property over decades. Another reason people sell is a lot of investors prefer a 5 to 10 year time horizon. That is something you'll know as you're meeting with them. People expect to put capital in and get it out in a 5 to 10 year window. So you're just selling based on kind of the plan that was put forward. Fort Capital usually underwrites every deal on a 5 to 7 year basis. And especially in our value add deals, our goal is to buy it and fix it and either sell it or refinance it. And so a lot of times it's just purely the plan is to sell, and there's no problem with that. The truth is, most investors hesitate to commit to a forever hold structure. The reality, though, is if the asset's performing and it makes sense, they'll hold for much longer than they initially planned. It's just that initial commitment to a forever that holds them up. But again, if you have a cash flowing property that's doing well and you've come up on your 5 or 7 year horizon, if it makes sense, people will still hold. But again, if the plan was a 5 or 7 year hold, a lot of people will just stick to that and sell in those time windows. Another reason people sell are tax reasons. Not so relevant in today's market, but you'll see companies sell real estate to harvest losses against gains. You'll see people sell because tax rates might be changing, like we're going to experience this year with the new administration. People are trying to sell their assets at a profit and pay the lesser tax rate than what could come in 2022. Funds in particular will sell because there's a limited time horizon they're allowed to hold assets. So closed-end funds have a lifetime ending, and it's in the documents. Sometimes it's 8 years, sometimes 9 years, sometimes 10 years. But funds you will often see are selling to satisfy the fund requirements. Funds usually have a start date and an end date. REITs will sell to satisfy public market perception. We're buying an office building right now from a REIT that made a statement in 2018 that they were going to become a pure play industrial REIT. And so they are selling off all of their non-core assets that do not meet that mandate. Similar to what we talked about earlier, it's just not a core part of their strategy anymore. And of course, merchant developers will sell because that's their business model. They develop a property, they get it leased, and then they sell it. That is the model. And so again, depending on who the owner is and what their intentions are, you will work with groups that their whole business plan is to sell as soon as a property is leased up. An owner-occupant could sell their business and choose to sell the real estate with it. So a lot of times you'll see business owners selling, and when they sell their business, they sell the real estate with it. Another reason to sell might be because you've aggregated enough assets. That's something Fort has done very well, where there is an aggregation premium or an arbitrage. And what I mean by that is if you own 3 or 4 assets, if you sold each one individually, you might sell it on a 6 cap. But if you were to sell them as a whole, you could sell them on a 5 cap. And so reasons to sell might be that you can achieve a much larger outcome by pooling several assets together than you could selling any one individual asset. So again, when arbitrage or aggregation premiums exist in the market, there's yet another reason to sell because you are achieving much higher returns for your investors simply by aggregating than selling off individually. So the list kind of goes on. You can see that there are a lot of reasons why people sell. There's no one right reason. Sometimes it's better to sell than others, and you're satisfying different requirements along the way. Situations change, markets change, incentives change, and there's just a lot of reasons to sell. So the next question is, what does selling do for an investment company? Selling provides the best possible data on market conditions. For companies like Fort that are always buying, we kind of know where we are. And so what I mean by that is Fort Capital for the last 2 years has had a portfolio of properties in the market to sell pretty much throughout the last 2 years. We're now on our 3rd portfolio sale that we're in the market on now. But for the last 2 years, we have had something in the market. And so when you're in the market and you're selling through a group like JLL that we work with, you are putting a package out. You are seeing the, hundreds of buyers that are in the data room looking. So you're getting a sense for who's in the market. You are getting a sense when it comes time to call for offers, how the offers are coming in and how your assets are being priced. And then usually when you get down to that last 3 or 4 buyers, the seller actually has an opportunity to do a buyer call. So Fort will get on the phone and talk to the final 3 or 4 buyers that are in the running to purchase the asset. And you get to ask them a lot of questions. How are you underwriting this asset? How are you reserving for CapEx? What are your lease assumptions? And how are you ultimately getting to that value that you're putting forward? And in all of this, you're learning how people are underwriting, how people are looking at assets, and ultimately how they're getting to the value. And so selling can be a great source of data, especially for a company like Fort that is aggressively buying. So we'll buy almost $250 million this year alone. We will have sold about $150 million. But when you're buying and selling at the same time, it makes you a lot more confident on your buys because you know where the sales market is. Another reason investment companies will sell is to build a track record. I was a big opponent of this kind of idea for a long time, that you had to sell something to actually make it part of your track record. I was always under the impression, why can't we just get a value of what it's worth today and tell investors and the market and banks and brokers and capital markets brokers that, hey, we didn't actually sell, but we could have sold for this much. And if we had, this would have been the return. And I was always met with resistance from investors and brokers and bankers. They wanted to see that a deal had gone, quote unquote, kind of full cycle, meaning you had bought it, you had created value, and you had actually sold it. And when I actually bought into the idea and we did it, I was met with the truth. It was absolutely true. As soon as we sold and were able to put a quote unquote skin on the wall, our track record started to build. People took us a lot more seriously. And it was ultimately a very big net positive for Fort and obviously for all of our investors who made great returns along the way. So building a track record is real. As deal sizes get larger, typically the type of investors change. A lot of these investors who can write larger checks want to see a track record of deals that have gone full cycle. So we were first met with this idea when we started raising equity and we were raising $5, $10, $15 million for a deal. The investors looking at those types of deals that are writing bigger checks wanted to see a track record. And at the time, we really didn't have one. We hadn't sold a whole lot yet. Now our track record is our front page that we'll send to anybody. And it's really important, especially as deals get bigger and you start going into new markets and you're working with new lenders and investors. It's important. I will say, as a track record gets better and there's a longer track record, the need to sell lessens. But again, early in a company, when you're trying to build one, it's important. Once you've built a great track record, you have a lot more flexibility and leverage. You have more investors that you can work with, more bankers, and you don't have to consistently prove that deals have gone full cycle. So the key is to build the track record, and then you have more options down the road. Another reason that it helps build a track record for a company is when you sell, often you can get PR and press coverage. And this, again, was something that I, kind of doubted that PR and press coverage would help Fort. And how does it help Fort? It helps Fort when it's in the paper or it's in the news. You start getting a lot of inbound inquiries from brokers and capital providers and new investors and new recruiting. People like to see that successful deals have happened. And I can tell you, every time we've sold a large portfolio, the phones have rung off the hook in the months that follow. And so we have seen new deals because of it. We've met new brokers. We've met a lot of new investors. And again, recruiting gets a lot better. So sales can have a much larger impact on the ecosystem of the GP than just the profit of that one deal. Let's take a quick break to highlight this episode's sponsor, Juniper Square. If you aren't familiar with Juniper Square, it's an easy-to-use, all-in-one investment management software designed specifically for real estate owners. We have been using it at Fort Capital for several years now, and it has completely revamped the experience we're able to provide our investors through reporting, management, and efficiency. Here's a bit more on how Fort Capital utilizes the platform. Depending on how fast you read, you can look at our deal, approve our deal, sign our deal, and send money for a deal in under 10 minutes, assuming you've already understood what the deal is. Like, the frictional cost of how that all moves through our system now is a matter of minutes, and it does not require any human interaction between that unless the investor wants it. We have investors that are in 15 different deals. They can go into their portal online, go to their profile, and everything they could want, from every document they've signed to every report we've sent, to every distribution we've sent, every point of contact with them throughout the life of the investment is documented in one place. You can check out episode 37 to listen to my full conversation with Brandon, or visit cjunipersquare.com for more information. That's SEE junipersquare.com. And now back to the show. So I think it's also important when you're talking about selling to understand the type of ownership and incentive structures, because they matter. And I'm going to speak specifically to kind of Fort Capital's world, which we consider ourselves real estate private equity. But I think there's kind of two styles of real estate private equity that I've learned over time. The first one is what I'll call kind of a family office style real estate private equity firm. And in this situation, the decisions to sell are often centralized around the owner or the family's desire for cash. So imagine here that the majority of profit and the majority of decisions are impacting one individual or a family or a couple of partners. And so there's a different incentive structure, depending on where those families or owners are in their career. Their decisions to sell are a lot more personal than kind of company related. Because again, the impact of a sale is going to have the largest impact on one or a few individuals, not more of a company-wide impact. And there's nothing wrong with that structure. That's how a lot of, legacy families have set up kind of real estate private equity firms, or really mature companies that have been around forever. And again, the owners might not need to sell. Or if they sell, it's for reasons like they might want to, go buy a house somewhere, a second home. And so they sell something, but it's a totally different process to decide because of who's being impacted. The second type of real estate private equity firm is what I'll call maybe an everyone gets rich private equity firm. Here, the business model is often to buy it, fix it, and sell it or refinance it. This is primarily for value add deals. In fact, this is the exact verbiage that Blackstone uses on their website to describe their real estate strategy. In these types of firms, when a sale is made, lots of employees might be getting paid, lots of LPs might be getting paid. And so the decision isn't just what is going to move the owner of the company's needle, but what's good for everybody collectively. Decisions to sell are often driven towards a larger group of stakeholders cashing in. If we found that most talented, it's been our experience in the world that we live in today, where things move quick, that a lot of the talented folks in the real estate industry simply don't want to wait 10 to 15 years to 20 years to get wealthy when they can join a firm where there's going to be wins along the way. And so in a strategy where you're holding real estate for really long periods of time, the employees, if they're participating in the upside of those assets, it can take a lot longer for that to build. And again, when you have a big company and in the world we live in today, the desire for a lot of top talent to wait long periods of time to kind of quote unquote get in the money, it's not out there. Again, creating a culture where that can exist is one thing, and that usually happens in more of a family office style real estate private equity firm. But it is important, and you can hire better talent when people know there's going to be wins along the way and not, these big wins that come way, way in the future. 10 to 15 years can be a lot of time. And in a market where things are rising and asset prices are going up, people want to see cash coming into their bank account. So again, the incentive to sell is not just an owner-driven decision. It's what's best for all the stakeholders. I will say also, when there are going to be lots of wins along the way, and there are lots of team members involved in the upside of those wins, it does create a more ownership and accountable dynamic. You have employees that ultimately know that their job and how they're impacting any one deal is going to create upside for them. And when they know that upside could come in 2, 3, 4 years as opposed to 10 or 15 years, you see people act differently, and incentives drive outcomes. And so we have found that it creates an ownership mentality within our organization by having periodic sales along the journey. Our large sales have been huge for team buy-in and culture. More than just the investment team starts to understand how their part of the business impacts the success of deals. Those teams are thinking about their work differently. How can we do more profitable deals? Some examples of how non-investment teams get sharper. Marketing might put more attention into marketing efforts to reach brokers, new investors, or market a property in the current portfolio better. Again, once the marketing team has received upside from a property, it's an extra shot in the arm for them to understand how marketing plays an impact in the deals that we do. Our tech team, they're incentivized to build better tools to help identify acquisition targets, or build tools that help the company use our data to make smarter decisions. Again, when somebody on the tech team has been the beneficiary of the upside of a deal, they now see how the fruits of what the technology they're building is going to impact the investments that we can make. Accounting realizes that clean financials make for better decisions and easier transactions. So you see accounting take more accountability. And property management, they are a big part of the investment. Once you buy the investment, they are the team that is running the asset, and they understand the need for happy tenants and managed expenses. When they see us sell something and they understand why we were able to sell something for more and what the future buyer wanted, property management can get smarter and operate our properties better to create more value and ultimately easier transactions. So Again, that's a long way of saying when you have an everybody get rich type of firm where you're having sales along the way, it just has not only a financial impact on your team, which it cannot be disregarded, but it continues to get them more bought in and thinking more like owners than teams that, might not see future upside for 10 or 15 years. It just creates a different dynamic, at least one that we've experienced at Fort Capital. So now I'm going to talk a little bit about Fort Capital's portfolio sales experience, and I'll start with a story. So as Fort Capital began to grow, we were getting asked more and more about our track record. I never quite understood why a full cycle deal was so important. Why couldn't I just sell investors or whomever was asking, well, we could have sold it for X, which would have generated X returns, but we didn't. I know I mentioned this earlier in the podcast, but it's important. As our deals got larger, the conversation kept coming up and up. I remember a specific meeting where I was talking to someone who was huge in real estate private equity world. He basically said, your first big sale will change the trajectory of your company. It would bring Fort credibility. Against my will at the time, we listened, and he was right. People ask me all the time, are you selling because you think we're at the top? My answer is no. We sell because it makes sense for us. I don't know where the top is more than anyone else on this planet. If I did, I wouldn't be doing real estate. With that said, if you understand the market you're in, like the one we're in now, it makes sense to sell if you're a seller. Interest rates are low, rents are growing rapidly. It's a very hot market. I know a lot of folks that are sellers who wish they had sold their properties in 2007, but missed the window because they were greedy. Obviously, nobody knew that was coming. But as they reflected, they can say, based on the information they had, it was a seller's market. I, again, having sold at Fort Capital, having sold 2 portfolios over the last 2 years, and we're in the market now. Again, I'm getting asked all the time, are you selling because we're at the top? No, I'm selling because it's a great selling environment. And I don't know if we're at the top. I don't know if we're 5 years away from the top, but I don't want to live with any regret. And I want our LPs to do really well in a time where they can do really well. And I want to keep putting skins on the wall because, again, if there is a downturn, the key isn't being a company where you can get capital and investors when things are great. The real key of being a great company is when you can get capital investors when things are not great. You do really well when capital is scarce and you have access to it. So as it relates to Fort Capital, the process by which we sell is important. So when you run a process, so you hire a capital markets broker, we hire JLL, and they put your deal together and they send it out to the world. JLL has thousands and thousands of buyers across the world that might see our company's name when a sale package goes out. That's a way for the world to get to know your company. And that's important. We now have people in New York and Boston and Miami and San Francisco and LA that know of us because they've seen something that we're selling and they were able to look us up and get to know us better. And again, they might not have been buyers, but we've heard from hundreds of different groups over the years that saw or met us because of a sale process we were going through. This is important for emerging GPs like Fort Capital. Again, it's brand awareness, it's company awareness. And, now people all across the country know of this little company in Fort Worth, Fort Capital, that's buying industrial all over the state of Texas. And it would be hard to have gotten that brand recognition in any other channels besides a big sale where it's being blasted for, 30 to 60 days. And then there's a process being run. So your name just becomes really relevant. And the more and more of those opportunities they see you in the market selling, the more they continue to become aware of who you are. Again, as I mentioned earlier, during this process, you get to see who's in the data room and who's ultimately making offers and why they're making offers and how they're valuing those offers. And in the best and final, like I said, you get on a call with 3 or 4 of them and you get a chance to meet the top buyers and understand how they looked and underwrote the deal. It's also an opportunity to learn more about their company and strategy, but ultimately it provides direct insight in real time as to where the market is for some people, and that directly helps us when we're buying. And For our LPs that invest in a lot of deals, they can feel confident that when we're buying something, we have an edge, so to speak, because we're also selling at the same time. And so we can see the margin of what we're buying at and what we're selling at. When Fort Capital sells, let's just be honest, we have happy investors. It's never a bad thing to do well for your investors and return capital. It's just not. This gives them more confidence to invest in future deals with you. It gives them new capital and more capital, and they might start making larger investments. They will also go tell people about their successful investment. They might tell somebody close to them who could become a future investor. But when you do well for people and you make a sale, we've never had an investor call us angry at a nice return. In fact, it's quite opposite. They thank us, they tell people, and they are more eager than ever to get into the next deal. So selling creates its own little flywheel in and of itself. I talked about press earlier, but when you sell, there's a lot of inbound capital providers, brokers, investors, recruiters, or recruits. You hear from a lot of people when you're in the press. And I can't say enough on just the recruiting of new investors. That's how new investors read about you. That's how new companies read about you. But people that might want to come work for you want to work for a winning team. And when they see big sales happening in the market, that's a company that they want to come work for. Some of the recruits that we've hired would say they first found us reading a press release. Our team, the team members achieve a financial win. That is always good. They are incentivized to do more wins. The culture becomes more of a winning culture. The people are more bought in. And when people are more bought in, they're working harder on the assets that you own because they know how the value is derived. We try and do a really good job at Fort, letting everybody know, no matter what position they're in, how Fort Capital makes money and how your job plays a role in that. It's not just the investment team or the finance team that have a role in that. It's every team. And so we have noticed that every time we've sold, our team has gotten more and more bought into what we're doing. They understand how they're impacting our assets. They care about saving money on operating expenses. They care about treating tenants well. They care about treating banks well. They care about delivering exceptional service to our investors. They just care more. And you might say, well, what kind of people are people that don't care if they don't get a financial win? That's not the right way to look at it. That is the incentives of the world. When people are winning and they're seeing financial windfalls and they're seeing their company and team win, it just ultimately creates a culture of more accountability and ownership. And it's never a bad thing to celebrate. Some of our best days at Fort have been celebrating a great win. The team is bonded more. We were recently able to take a couple of trips where we celebrated, and those were trips we'll never forget. The team got closer. We were able to talk about our wins, and it was huge. And all the while, our LPs did well, our banks were paid, our brokers did well. Everybody does well in a good sale. And again, I won't beat this horse too bad, but the track record. Whether we like it or not, a track record is built on results, and results often include seeing a deal full cycle. The more skins you can put on the wall, the better your track record is. And what does a solid track record do? Again, it attracts equity, it attracts lenders, recruits, and vendors all around. As I mentioned above, as the track record improves, the flexibility of the GP gets better so they can make more decisions that aren't having to be based on just selling, but they can hold for longer. Because they have better lenders, they might have better refinance opportunities. Because they have better investors, they might have different ways to structure deals. Because they have great vendors, they might be able to negotiate better on pricing, especially as they get scale. So it just gives a GP more flexibility, and a GP with flexibility is a positive thing. They can make clear decisions that aren't driven by just one thing. They can make the decisions that are the right decisions and not the decisions that are forced upon them by some document because they didn't have a track record and they were forced to sell something to post a skin on the wall. It lowers the cost of capital. If you have a track record of doing lots of full cycle deals and generating returns, you can borrow better. You can get better terms on deals. You can negotiate with vendors better. It just gives you more leverage ultimately to achieve a lower cost of capital, which a lower cost of capital makes you more competitive going forward in your new investments. And again, lenders are just more eager to lend. Lenders love working with folks that have a lot of experience, that have experience paying banks, paying off banks, being great customers of banks. And so the track record is not just the return, but it's how everybody along the way was impacted and ultimately continues to give the GP strength in the market to make new investments, better investments, operate them better, recruit better, et cetera, et cetera. So I've gone through why people sell, the different types of structures that make up these investment firms that lead to the incentives of why they might sell. I've gone through some examples of how it's impacted Fort Capital from a story that I told, the process that we go through, happy investors, what happens when you make investors happy, how press can help, how it impacts the team. I've talked a ton about track record, but ultimately the decision to sell is in the eye of the beholder. There's a ton of reasons why to sell. There's not any one that's better than the other. There are reasons to sell when things are great. There are reasons to sell when things aren't so great. But the incentives of the GP, the culture of the team that owns those assets, the way that decisions are made and who they're impacting, the growth trajectory of a company and the goals of that company, they all play a factor. So there is no one right answer, but this should give you more clarity on why groups like Fort Capital and others might sell, why groups might not sell. But ultimately, selling is not a bad thing, in my opinion. It leads to much bigger upside than just the financial win of that one asset. And if you're building a company that you want to build over a long period of time, most real estate companies are built over decades and generations, then selling along the way could be a huge tool to build a great team, create a great track record, and ultimately create great financial wins for all stakeholders involved. So thanks for continuing to join me on this journey, and I hope you enjoyed today's episode. Hey everyone, it's Chris here again. Thank you so much for joining me on this journey. If you enjoyed the show, please follow the show on Apple, Spotify, or subscribe on YouTube. Thanks again, and I'll see you on the next episode.
Chris Powers is the founder and chairman of Fort Capital LP. All opinions from Chris and guests of the Fort podcast are solely their own and do not reflect the opinions of Fort Capital LP. This podcast is for informational purposes only and should not be relied upon for real estate or investment decisions. The Fort with Chris Powers is produced by Straight Up Podcasts.